like to play golf and stuff. You know, I don't play golf, so that's what I do.
I think that's a lie.
Morning, everyone. Thank you.
Sorry, the technology is not working. Yes, hi Brandon. I'm in Bauer Hall 160 in the TV. I got a class that just started. Okay, thank you. Bye. Okay, if we can go ahead and get started. I think we're on about slide 38 of chapter 4. If we want to follow along so we get the technology going. So remember we were talking about separate limitation losses. And so these are the FTC baskets we do. There's 4 baskets. And so I'm going to send you guys a flow chart that I'm going to do to kind of simplify this. But I think the first question to ask is, do I have a loss in one of those baskets? easiest one to think about is the foreign branch basket. What if my foreign branch operations create a loss? The first thing I do is share it amongst the other baskets, right? And if the overall is positive amongst the 4 baskets, then that's all I do is I share it, the loss basket, to the other positive baskets, and then I recapture it in the future as my loss basket makes money. In the future, I give it back to the baskets I offset. That's the separate limitation loss rules. If the overall 4 baskets have a loss themselves in total, then that's the overall foreign loss. That's where we left off on Monday. Then that offsets the U.S. taxable income, right? Because we tax on a worldwide basis. And that's where the U.S. sets up a recapture regime saying, yes, I will compensate you for your foreign losses by offsetting your U.S. taxable income. But when you then make money in the foreign, yeah, it's a, that's good. Question 1 of all IT, make sure it's plugged in. Thank you. Great, thank you. All right, we're rolling now. Well, that's the overall foreign loss we had. We left with this example, 420. And what I really want you to focus on is that offset on the left there. That's when I have an overall foreign loss, and that offsets my U.S. source income. Okay, so here's the offset we're talking about. Okay, so we're talking about the offset of the overall foreign loss. So the sum of my 4 baskets is a loss that offsets my U.S. source taxable income. The effect of an OFL is that's a current year benefit. In the future, I have to give back the foreign source income that would otherwise be created in year 2. This is the haircut in year 2. I had 100,000, but I only get to count 50,000. That's foreign source income. That's the net effect of that. I don't get a double benefit. Okay. The overall domestic loss is when I have a domestic loss that offsets my foreign source income. That will also frustrate the ability to claim my foreign tax credit because I won't have a liability, right? So I can't credit foreign tax against the 0 tax liability. So that's the next example, and I think this is 421 Claude. Claude is not here. Anybody want this one? Let's come on out.
We have one USA called Parents Worldwide Income Household $100,000 of foreign source income on which U.S. code paid $30,000 of credible foreign taxes and an ODL of $100,000. Consequently, U.S. code is in the only viable position of paying $30,000 of credible foreign taxes, despite not having any worldwide income. However, these excess foreign tax credits can be carried forward 10 years.
So it is unenviable because they paid foreign tax they won't be able to credit, but they also didn't pay any U.S. tax because that $100,000 of ODL was they didn't have any U.S. tax, right? So they didn't pay any tax in the U.S. So yes, it is a problem from pure FTC. Okay.
In year 2, U.S. code again earns $100,000 of foreign source income, for which it again pays $30,000 of credible foreign taxes. However, the U.S. operations turn around and earn U.S. source income of $100,000, resulting in a pre-credit U.S. tax of $42,000, which is the 21% worldwide income. In addition, U.S. code may recapture as foreign source income $50,000, which is the lesser of 50% of the U.S. source income of $100,000 in year 2, or the previously unrecaptured ODL of $100,000. The ODL recaptures income increase U.S. code's foreign source income from $100,000 to $150,000 and increases U.S. code foreign tax credit limitations from $21,000 to $31,500. Consequently, in year 2, U.S. code may claim a foreign tax credit for $1,500 of the excess credits from year 1, in addition to the $30,000 of credible foreign taxes in year 2.
So it's not a full recapture; it's 50%, both on the OFL side and the ODL side. But it's the combination of the carry forward of the credit and then the resourcing of income in the recapture year, which helps provide the limitation to utilize the credit in the carry forward year. That's the whole concept between OFL and ODL, restoring the two, because again, the real world's messy. Not everybody makes money. Okay, so that's the deep end of foreign tax credits, right? That's ODL, OFL, SLL. That's when you're in the weeds. Okay. If you do have creditable foreign taxes that exceed your FTC limitation in a given taxable year, as we've talked about, it can be carried back 1 and forward 10, and taken as a credit in the year the FTC limitation exceeds the creditable foreign taxes incurred in that year. Carry back, carry forward. The allowance of the carry back, carry forward attempts to lessen the likelihood of double taxation and mitigates the likelihood that an FTC cannot be claimed solely because of changes in the tax rates of a foreign country. Just like the U.S. changes their tax rate, other countries change their foreign tax rates, so that can cause the amount of foreign tax to vary over a period of time. Again, carry back, carry forward is the U.S. is not going to do it on a year-by-year basis. We want to give you a wider berth to try to be able to claim those credits. Another one is when there's a timing difference relative to the recognition of income or expense between the U.S. and the foreign country. Remember, when we do our sourcing and computations, we do everything based on U.S. tax principles. The foreign jurisdiction, which assesses the foreign tax liability, has their own rules on when items are taxable, when items are deductible. So we could have differences between the two. Again, giving a wider period in which to claim the credit allows for some of those timing differences to smooth out, as opposed to a year-by-year determination. And the last one is when a country chooses to enact or eliminate taxation of an item preferentially compared to the U.S. tax treatment. Again, if someone taxes a particular item at a lower or higher rate, that can cause a spike or a reduction in foreign tax. I need longer periods of time to try to smooth that out to utilize that credit. I don't believe anybody volunteered for 422. Does anybody want to do 420? Go ahead, Jared. This example shows you the benefit of a carry-back potential and why that's important for tax.
U.S. code realizes $20 million of foreign source gross income in both year 1 and year 2. Assume that the U.S. and foreign tax rates are both 21%. The only deduction allocable against this income is a $20 million expenditure that USA Code deducts over 2 years for U.S. tax purposes, but just 1 year for foreign tax purposes.
So you see down here in the chart, the top part is the foreign tax return. They're taking the full 20 million in year 1. There's a typo in the text, but it's 0 in year 2. Compare that to the U.S. when we put on our U.S. hat, and we look at this from a U.S. tax principle, we say no, that expenditure belongs half in 1 year, in year 1, and half in year 2, so we pay 10 and 10. We have a timing difference between U.S. tax law and foreign tax law. Okay?
As a result, USA Code's credible foreign taxes are 0 in year 1 and 4.2 million in year 2.
And that's just the foreign tax that's paid, right? They don't pay anything in year 1 because they have no taxable income, and they have 20 million in year 2. Okay.
In contrast, USA Code's foreign source income for U.S. tax purposes is 10 million in each of year 1 and year 2. Therefore, USA Code's foreign tax credit limitation is 2.1 million in each year. If there were no excess credit carryover provision, USA Code could claim a credit in year 2 for only 2.1 million of the 4.2 million in foreign taxes paid. With the carryover provisions, USA Code can carry the excess credits from year 2 back to year 1 and credit them against the excess income limitation of 2.1 million for that year.
Yeah, so I paid 4.2 in year 2. I can utilize 2.1 of that in that year, because that's that year's FTC limitation at the bottom. But I also then have excess credits of 2.1. I first go back to year 1. Hey, do I have limitation in year 1? Oh yeah, I got 2.1. I can amend that tax return in year 1, claim a refund for the 2.1 million of tax I paid, and I'll get a check from the U.S. government. That's the magnitude of why the U.S. is trying to help you mitigate double taxation. If they didn't have it, you would have paid double tax in year 2. Okay, so FTC compliance requirements. So how do I report all of this on the tax return? A U.S. corporation claiming an FTC prepares Form 1118. If you're working in a corporate tax department that has international, you will become an expert in Form 1118. That's all the rules we've been talking about. All the sourcing of the income, all the sourcing of the expenses, the SLL, the OFL, the ODL, all those components are wrapped into the Form 1118. And that is a supplemental form that gets attached to the Form 1120, which is the overall corporate tax return. A U.S. individual, because U.S. persons can claim a foreign tax credit, their analogous form is 1116, which has similar provisions as the 1118, but that gets attached to the individual tax return form. Okay? And the appendix to Chapter 4 has some all the examples that we've been going through, baked into the 1118 or 1116 on those forms in that. You also need to maintain proof of your creditable foreign taxes. So one of the first things the IRS asks when you start to claim a credit is show me proof of your foreign taxes. And so usually you have to show them your foreign tax return. You might have to show them wire receipts where you've sent money from a bank account to a foreign government. They want to first, let's talk about the amount of credits that we're talking about. If you don't have that support for the amount of foreign tax that you're trying to credit, then the government will put it at 0. But the burden's on the taxpayer to support their foreign tax payments. So you usually typically keep a file where you keep all your foreign tax receipts into those things. Now what's interesting here, I didn't drag you through this detail, but you know, just like in the U.S. where you file a tax return, the government has so much time before they can audit the tax return. And many times when the government audits a tax return, they make changes. They propose changes. Either they don't think you applied the law right, or they don't think you have the right facts, so they make adjustments to your tax return and maybe assess additional tax. That happens all around the world. Every government, you file a tax return, they have a period of time. The length of time varies by government, but they have a time where they can look at your tax return and propose adjustments. So think about this. If you're in 50 different countries, say you file 50 different tax returns, You're trying to credit those taxes you paid. Well, what if one of the foreign countries assesses additional tax years from now for that prior year? That's called a foreign tax redetermination in U.S. tax parlance. Meaning we have to make an adjustment to our tax return in reference to the foreign taxes either going up or down that we claim the credit on. And so that can be challenging. So this is constantly like I think of it as a moving target. As not everything, nothing's certain on day one. There's adjustments that can happen throughout the years, and you have to go back and amend these tax returns. So just think about that compliance burden of managing all of this and managing the governments involved. They can be very, very time-consuming. Okay? So we covered a lot in foreign tax credits here. So obviously when we get to the exam, how do you compute the foreign tax credit, the sourcing, get to the foreign tax credit limitation, and then working through in what year I get to claim that credit is going to be important. Okay? All right. I want to switch to chapter 5. Chapter 5 is our last big topic for outbound. So this is our U.S. multinationals investing abroad. And these are bucketed and called anti-deferral regimes. And we're going to spend some time first, before we get into anti-deferral, what does deferral mean? And then these exception rules, which are anti-deferral rules, working through those. But the fact pattern we're dealing with here is typically a U.S. parent corporation that has foreign subsidiary corporations around the world. Okay? Very, very common for your multinational companies. And again, I always say there's 50 countries, but that's not an exaggeration. They could be in multiple countries. They could have multiple legal entities in multiple countries as well. So you see these word charts. They can be overwhelming at times. We're talking about at what point does the U.S. assess taxation of those foreign subsidiaries that are owned by a U.S. corporation? Okay, and then we're going to go through some of these regimes, and you'll see here we have, this is some of the complexity we have from our government doing the One Big Beautiful Bill Act of July 4th last year. We have a regime that goes from 2018 to 25, so if you're going to be involved in doing tax returns for the prior year, you're in the guilty regime. We're going to talk about the details of that computation. If you're going to be involved starting in 26, you're going to be in a different regime. Very similar to the guilty regime, but they've tweaked it. And so by tweaking it in the computation, they had to rename it because it's focused on a little different thing. So it's the net CFC tested income. And that's beginning in 26 and is prospective until Congress at some point comes in and changes that law. Okay, so that's where we're headed. So what does deferral mean? Deferral of U.S. tax on the earnings of a foreign subsidiary. Okay, so we're not talking about the income that you earn directly. Meaning that if a U.S. corporation, we've had numerous examples where they have branch operations in the foreign countries. A branch operation is taxed immediately, it flows through to the owner. There is no deferral. We don't need anti-deferral because there is no deferral. Okay? Income streams that you receive directly, like we had some examples where the U.S. company receives interest payments, they receive royalty payments. There's no deferral. Those are immediately taxed. Those are income streams received directly in the U.S. What we're talking about here is income earned by a foreign subsidiary corporation. So historically, the U.S. did not tax foreign business income earned by a U.S. person via that foreign subsidiary corporation until it was repatriated or distributed in the form of a dividend from that subsidiary to the U.S. owner. A policy known as deferral. So it made money, the foreign subsidiary, but we didn't tax it. Even though we're worldwide taxation, right, you know that, we don't tax it until it decides to pay a dividend to the U.S. Okay? That's an affirmative act within the control of the shareholder and the board of directors of the dividend-paying subsidiary. So you can imagine what could happen. That could push out the incidence of U.S. taxation for a number of years. You don't have to pay it, right? That's up to the board of directors and the shareholders complaining about not getting a dividend, right? But that is the general rule, is deferral. Now, what you'll see when we get through this chapter is over time, the U.S. has written enough exceptions to where the exception swallows the general rule. So there's very little room for deferred income from foreign subsidiaries from U.S. taxation. Okay? And I'll tell you why when we get there as to why we've ended up in the space where we are. But if you had a policy of deferral, what does that mean? That allows U.S. companies to compete in foreign markets on tax parity with foreign competitors in that market. And that's an example, remember way back when we talked about capital import neutrality, is that all activity in a given jurisdiction should be subject to the same rate of tax. If the U.S. is not taxing their foreign subsidiaries in those foreign markets, then foreign competitors that are in that same market are paying, everybody's paying the same amount of tax, because that second incidence of U.S. tax is not yet affected yet because it's deferred, waiting for a distribution of the dividend. So it's very, very conducive to competitiveness arguments of U.S. multinationals, that I need to be competitive in my markets. Now, like I said, our exceptions have swallowed up the general rule, so the competitiveness situation is not clean from a U.S. perspective. That's why U.S. multinationals continue to lobby about these regimes. And so that one big beautiful bill act, when we get to the guilty regime that changed to the net CFC tested income regime in 26, the tweaks that were made are somewhat favorable to corporate America. And I said, in contrast, think about when I have income earned via foreign branch, or I earn directly income streams by the U.S. person. So think of export sales of inventory from the U.S. That's a sale. That's taxable. No deferral. Or the receipt of interest and royalties or rents coming directly to the U.S. That's just current taxable income. So we're not talking about deferral there, because there is no opportunity to defer that. Only if you have a foreign corporation. So example 5.1, Rocio.
Earns $5 million from its U.S. operations and has 2 foreign operations. The first foreign operation in country F1 is an unincorporated branch that earns $1 million. The second foreign operation in country F2 is incorporated as a foreign subsidiary that earns $2 million. U.S. total worldwide income is $6 million, comprised of the $5 million earned in the United States and the $1 million earned in country F1. U.S. code generally defers the $2 million earned by the country F2 subsidiary only repatriated.
Yeah, unrepatriated. So everything in the red circle is currently on the U.S. tax return every year, right? Because F1 is a branch. It's not a separate legal entity than U.S. code in this example. But F2, being a foreign subsidiary, the general rule, deferral of taxation in the U.S. until that entity makes a dividend distribution in the United States, subject to the anti-deferral regimes that we're going to talk about in this chapter. Okay? So that's the concept I want you to kind of stay grounded with on deferral. Again, we're going to swallow up deferral with our anti-deferral regimes, but I think it's good to stay grounded in this because this stuff does change over time. Okay. So left unchecked, a pure or complete deferral creates an opportunity to avoid U.S. taxes on passive investment type income, profits on the sale of inventory, and other income that taxpayers can easily shift from the U.S. to its foreign subsidiary corporation. Okay, so if I'm not going to tax the income of F2 in this prior example, if the rule was pure deferral, then every dollar of income that I could move from the U.S. into F2 and pay tax at less than 21% rate, I've saved global tax. Right? Because if it was going to be in this red circle, red oval, it was going to be taxed at 21. If I could put it into F2 and we were in a world of complete deferral, pure deferral, no anti-deferral regimes, then I would save U.S. tax, save global tax. So long as F2 tax rate was less than 21% corporate U.S. rate. Right? So you can imagine why the U.S. is concerned about that over time. It said, yes, deferral is the general rule, but I want to make exceptions for certain things that I think are inappropriate from taxpayer behavior. Okay, so, and think of several countries. So the island countries, Cayman Islands, you probably have heard in the movies and everything, is a tax haven. A tax haven means that it's typically a 0% tax rate. Okay, so some countries, they're sovereigns, right? They can choose their tax rate. Some countries choose a rate of 0. Now, they still need money to do things that a government does, like roads, police force, court systems. But think of island countries. They can get money from hotel taxes, tourist taxes, things like that. They get enough money other than needing an income tax. Right? So they're not doing manufacturing. There's no manufacturing going on in the Cayman Islands. Right? There's nothing going on there. But if I could move income from the United States to the Cayman Islands, then I'm taking something that was taxed at 21, now I'm making it taxed at 0. Depending on how I'm shifting the income, that's where the U.S. is going to have these anti-deferral regimes come up and says, well, that income I am going to tax irrespective of you making a distribution. So it's not just the Cayman Islands. Hong Kong, Ireland, and Singapore have traditionally been lower tax jurisdictions than 21. And they offer low rates of tax to try to induce foreign investment. So their countries on their own are trying to attract investment. So if they're below 21, and they have an inclination to attract investment, then the U.S. is also focused on those countries as well. And we're not necessarily focused on the country, we're focused on the type of income you're trying to move into that country. Okay? So what type of income could that be that I would shift from the U.S. to its foreign subsidiary? I could move the asset that's giving rise to the income, right? Typically, the owner of the asset is entitled to the return on the asset. So think of if I have a piece of intellectual property that I've been licensing out to the world, I've been collecting royalties on that. Well, if I own that intellectual property in the U.S., we know that royalties getting paid to the U.S., there is no deferral, it's taxed at 21. What if I contributed that intellectual property to the Cayman Islands company? Now Cayman Islands owns the intellectual property. They're entitled to the royalties. They're going to tax it at 0. I could easily move the income stream by moving the asset. The U.S. is going to be focused on that. Moving the asset inappropriately to attract the income at a lower rate of tax. The second way I could typically move profits is supply chain again, right? If you've taken any of those courses. Many large organizations are doing transactions amongst different parts of the organization. One of those transactions could be inventory sales. I could sell inventory through one of these foreign subsidiaries on its way to a customer and capture some margin in the foreign subsidiary. That's a way to move profits. It would have all been in the United States if I'd have sold it directly to the customer from the United States. But if I start routing it through subsidiaries on its way to the customer, maybe I have an opportunity to capture margin in different locations and maybe at a lower than a 21% rate. The U.S. is focused on that as well. Again, because that's related parties. I have a lot of influence on related parties as to how I move my transactions. So when we're going through this first part that we're going to go through today, subpart F, just the portion of the code that contains these rules, but subpart F is focused on these two items. Have you moved an asset inappropriately, or have you structured a transaction inappropriately? Shift income. Think of shifting income. Income that would have been in the United States, you put offshore. That's where the U.S. is saying, I want to tax that, irrespective of deferral. Okay, 5.2. may sign up for 5-2. Go ahead, Anderson.
I didn't look at the list this morning.
Yeah, so this part is just basic information that has two phases. So USA Co. is a U.S. corporation that manufactures electric generators for sale both in the United States and Germany. Jerco, wholly owned German sales subsidiary, sells generators to German customers. USA Co.'s generators have a cost of goods sold of $600 and sell for $1,000 in Germany. Therefore, the combined gross profit from a German sale is $400. USA Co. also has a wholly owned Cayman Islands subsidiary, CACO, which does not perform any functions with respect to the manufacture or sale of USA Co. generators.
So that's very important. The determinations that we're going to make throughout this section is what is that subsidiary actually doing in the supply chain? If it's just buying and then selling, there's no employees, there's no real activity going on relative to the sale, that's going to be a red flashing light, which I like to think of as that's the base company in the parlance of this area of the tax code. We're looking for base companies. Things that look like a third wheel, if you like analogies, something that's unnecessary. Like, why, if you're selling something to Germany, yes, it makes sense for you to have a German subsidiary, right? Because you're going to have employees, they're going to be talking to the customers, they're going to be servicing the product, whatever. That makes sense, right? Have a location in the country. But when you're starting to then say, well, why are you selling it first through the Cayman Islands on its way to Germany? That looks odd. That looks like you might be doing something inappropriate. So that's why I highlight just like the facts there. It tells us CACO does not perform any functions with respect to the manufacturer or the sale. That's a red flag that, well, I shouldn't be running profit through that entity. Okay.
Yeah, and then assume that the U.S. tax rate is 21%, the German rate is 30%, and the Cayman Islands does not have corporate tax. We'll go to case one. In this case, they do not route the sale through the base company. So in this case, it's taking this information that the transfer price for USA Co. sale to Jerco is $800. So they sell it for $800, and back from the previous information, the cost of goods sold is $600. So that has a gross profit of $200, which would be taxed in the United States. Then you take the transfer price from the sale from USA to Jerco, which becomes the cost of goods sold in Germany. And they sell it for $1,000, which gives a gross profit of $200 for German tax. And then the total tax on the $400 gross profit is $102, which results in a global effective tax rate of 25%.
Because it's a blend between the two rates, right? And there's nothing inappropriate in that transaction flow for me as an experienced tax planner. I'm selling to German customers, again, selling through my German subsidiary makes sense. And the pricing, the 200 of profit, which is a function of the sales price, because I chose to sell it from the US to 800, and then Germany sells it to 1,000, up to 1,000. That allocation of the global supply profit, global supply chain profit, has to be in accordance with transfer pricing rules. Transfer pricing is the regime throughout the world that makes pricing of intercompany transactions have to reflect the pricing that would have reflected if all the parties were unrelated. Meaning that if Jerco was an unrelated distributor, how much would I have sold it for? So this is presuming that my $800 sales price is in accordance with the arm's length transaction, meaning that Jerco is entitled to an additional $200 of profit, right? They're doing something. Logistics, sales activities, those types of customer relations, all that stuff that attracts $200 of the system-wide profit. Okay? So compare and contrast this when they start to try to do something creative.
Yeah, so in this case, they go through the base company, and it gives a bunch of information, but the USA sells the CACO at a $700 transfer price. So the effect on USA Co. would be sell it for $700, and their cost of goods sold from the original information is $600. So they have a profit of $100. Then you take that transfer price, which becomes the cost of goods sold for CACO. They have a transfer price to Jerco of $900. So the $900 minus the $700 gives a gross profit of $200. And then you take that transfer price to the cost of goods sold for Jerco, which is $900. And then eventually sell it for $1,000, which is the gross profit of $100 in German tax.
So I've essentially taken 100 from each of my tax-paying jurisdictions and not tried to purposely put that in CAICO. in this example.
And that eventually gives us an effective tax rate of 12.75, and that's lower because CAICO does not have any tax.
Yes. And so you got two countries here that are interested in this transaction, right? The US and Germany, those are two very sophisticated tax jurisdictions. They are going to be interested in why is CAICO entitled to $200 of the system-wide profit, right? And the facts tell us you're not going to be able to point to, oh, there's some superstar salespeople or there's some manufacturing going on. Everyone knows there's no manufacturing done in the Cayman Islands. And so you're going to have a very tough story to tell from one, a transfer pricing perspective as to why they're entitled to 200. But in addition to that, the U.S. applying their anti-deferral regime and saying, I think this is inappropriate because although some profit can reside in Germany, I don't see why any profit needs to reside in Cayman. Okay? That's the base company that we're going to, something that sticks out like a sore thumb, right? Like, why is this in the transaction? Okay, perfect, thank you. Okay, so we have several regimes set up to deal with that problem. I was trying to show you what the problem is, okay? And so they serve as exceptions to the general rule of deferral. I think it's still useful to think of a general rule as deferral, even though these exceptions tend to eat most of the general rule. But we're going to refer to these as anti-deferral regimes. They result in current U.S. taxation of foreign operating earnings in particular sequence because of the rules as to what type of foreign earnings are targeted by these regimes, and the FTCs allowed for associated foreign tax incurred. So, as I mentioned several times, the U.S. never starts from a blank sheet of paper. We have existing rules, and then we start piling on different things. And so these rules didn't come online at the same time. Subpart F, the first one we're going to talk about for today, is very old. It goes back to like 1962. President Kennedy, that administration came up with this rule. So that's been around for a long time. Now, the U.S. constantly makes tweaks to it, but the lineage of that rule reaches far back. Now, the GILTI regime, that was from Trump 1.0, when they did the overhaul to the tax code and Tax Cuts and Jobs Act. They came up with the GILTI regime. They all refer to the GILTI regime, but global intangible low tax income. We'll talk about that on Monday, about what type of income is that targeting. And then Trump 2.0 came along and said, we want to tweak what we did in 2017 when the One Big Beautiful Bill Act. So they tweaked number 2, and by tweaking it, it was not fair anymore to call it. Sorry about that. I was just bragging the other day how good the technology is. Okay, so I'm on slide 9. It was no longer good to call it the global intangible low tax income regime anymore, so it became this net CFC tested income. But I want to again teach you the GILTI regime because we didn't just scrap the entire thing, we tweaked that and renamed it, but it's effective beginning January 1 of this year. Okay. Okay, sorry about that. So subpart F income, we're going to talk about that first. So it's called subpart F, which sounds different, sounds a strange thing to call something, but that's because that's the section in the Internal Revenue Code. We have Title 26 is the Internal Revenue Code. All the laws in the United States are titles, so it's just Title 26 is the Income Tax Code. And then within that you have chapters, you have subchapters, you have titles, you have subchapters and subparts and that type of thing. So when you get all the way down through that table of contents, subpart F is where these rules are. So everybody calls it subpart F. And hear, oh, we have subpart F income from this or that, and that's what they're talking about. Okay, so as mentioned, left unchecked, a pure deferral policy would create an incentive to avoid U.S. tax on relatively portable income. So think of investment type income, which I can move just by moving the asset, and related party sales and services income, like that prior example that Anderson went over, just by how I do the intercompany transactions. It's relatively portable for a global organization to where I put that income. So it could be rather easily moved from the U.S. to a foreign subsidiary corporation taxed or located in a low tax country, i.e. one that is a tax rate below 21%. This was really, really common in pre-Trump 1.0. Remember, we had a 35% historical tax rate. There's a lot of countries were below 35%. Now the threshold has been moved down to 21%. There's not as many. We're about in the middle, if you want to think of the hierarchy of tax rates around the world. 21's roughly in the middle, but obviously a lot less than when we were at 35. So there's not as much pressure, but companies are always trying to pay the least amount of foreign tax. So if I can move income from a jurisdiction to a lower tax jurisdiction and not run afoul of these rules, that's still a very, very fruitful exercise for multinationals. Okay, and so this subpart F is our first exception to the general deferral rule. And what I want you to understand about subpart F is it's not focused on countries. It is focused on the types of income. What type of income is being earned in that foreign subsidiary? That is the focus of subpart F. When we get into the GILTI regime and the net CFC tested income regime, the numbers 2 and 3 on that prior slide, they're not focused on type of income. They're focused on all income. So subpart F is a historical rule where we look down and see what's going on in that foreign subsidiary. Where did their income come from? Okay. So subpart F regime requires a U.S. shareholder of a CFC. There's a lot of defined terms here, put in the bubble there. So you gotta understand what the defined terms mean to be able to navigate within subpart F. So U.S. shareholder, I bolded that. We'll talk about what is a U.S. shareholder, who is not a U.S. shareholder, and then controlled foreign corporation, CFC. So if I meet those two to be discussed definitions, then I currently include, which means irrespective of whether the CFC pays a dividend. I don't care about the deferral rule anymore. I currently include that CFC's income in the U.S. tax return. If its gross income, in its gross income, its pro rata share of certain types of income earned by the CFC, we refer to that as subpart F income. I might be paying foreign tax on these income streams as well, because not everything's a Cayman tax rate, right? So in that instance, I didn't need to worry about claiming a foreign tax credit because there was no foreign tax paid for what Cayman earned because it was a 0% tax rate. But many times I'm doing things in a lower tax jurisdiction, but not a zero tax jurisdiction. So if my subpart F income includes some foreign taxes associated with it, the U.S. says I am taxing that income, but I don't want to double tax it. So all the stuff we just talked about foreign tax credit would apply. I'm going to do my FTC limitation and take credit. Okay. So the first thing I got to do is define and see if I got a controlled foreign corporation. I have to identify in my organizational structure, do I have a CFC? And as I mentioned, I think before, if you're in a non-US setting where I have a foreign parent, they have many of those countries have CFC rules as well. So it's not uncommon. A lot of these countries follow what the US does from a legislative standpoint. It's like, oh, that's a good idea. I'll do that. And so that's why we started with CFC rules back in the 60s. Other countries have come online. They have certain CFC rules as well. And so each country has a different definition of what is or is not a CFC. So under the US law, a foreign corporation is a CFC if on any day during the taxable year U.S. shareholders collectively own greater than 50% of the combined voting power and value of the foreign corporation. So, first thing you see is got to be U.S. shareholders, and I capitalize that. We're going to define that in a moment. And collectively, those U.S. shareholders have to own greater than 50, not 50, greater than 50. You have to control it, right? So it's a CFC. You have to control it. Think of if there was a vote. You don't control it if you only have 50% of the vote. If you have 50.1, now you control it because you got all the votes. Okay, so what counts as a U.S. shareholder? That is any U.S. person. Remember when we talked early on what a U.S. person is? That's a U.S. citizen, resident alien, a U.S. corporation, a U.S. partnership. Those are our U.S. persons. So first we got to have U.S. persons, and they have to own at least 10% of the voting power and value of a foreign corporation. I'm looking for big owners. Big. If you own greater than 10% of a corporation, you're a big owner, right? Many times this is simple because if in a wholly owned nature, when you got a U.S. parent company who owns 100% of a foreign subsidiary, you know it's a CFC. You got one U.S. shareholder and they own 100%. But it's possible to have multiple U.S. shareholders, which we'll see.
I wanted to ask about subpart F. Is it still relevant when there's guilty? I'm not sure. Like
Yes, because if you go back to slide 9, it applies in that order. So subpart F is applied first. So it picks up the income first. Whatever is not included under subpart F then has to run through the guilty regime and then the net CFC tested income regime. Good question. It may not make a whole lot of difference at the end of the day, but technically it goes through that order because it's different FTC rules. Okay, so I need U.S. shareholders, U.S. persons who own 10%, at least 10%, and I look at all forms of ownership in determining U.S. shareholder status and whether I am collectively own greater than 50% by all those U.S. shareholders. And where this gets complicated, so all forms of ownership, so direct ownership, what do I own in that entity? Indirect, what do I own in that entity through another entity? So what if I own some directly, and I own some through a partnership, who then the partnership owns some directly? I am attributed ownership what I own indirectly. And then constructive ownership is the third prong of ownership that's common in the U.S. tax code. That's where I own what someone else owns that's not indirect. So, for instance, I can get constructive ownership through my daughter. If my daughter owns stock, then I'm deemed to own what my daughter owns. So, in a very complicated shared ownership fact pattern, I have to blast through direct, indirect, and constructive ownership in determining one, am I a U.S. shareholder, and then adding all those U.S. shareholders and then saying, do they collectively own greater than 50%? So it could be quite the exercise. It's either really simple in a wholly owned setting, or if you have a very scattered ownership, it can be really complicated. The rationale underlying the application of subpart F to only CFCs is that the presence of control of the foreign corporation by significant U.S. shareholders, those greater than 10% owners, it warrants scrutiny for potential inappropriate movement of mobile income from the U.S. abroad. Right? They're looking to objectively define situations where there could be some influence on how income is earned in the global organization. Right? So they're looking for big owners and then collectively greater than 50%, because then you can decide where are assets held, how are transactions structured. Right? If you don't have that, then there's not somebody pulling the strings, if you will, as to where income is earned in the eyes of the government. That's why all countries have it be a controlled foreign corporation, because they want some manipulation is possible on structuring flows and income. Okay. Somebody volunteer for 5-4. Anybody want 5-4? George. I apologize, we don't have this on screen, so hopefully you have slide 13. We're gonna go through and test around whether something is or is not a CFC. Because sorry, before you get started, if you're not a CFC, you cannot generate subpart F income. Right? We need that, that's the gate question. So we have to first determine whether we have a CFC to see if we can have the types of income that would be included under subpart F. Okay.
Yeah, so in this example, Uncle Sam and George Washington, both are US persons, and each owns 26% of cocoa for the entire year. Norman Ray Allen, an unresident, owns the remaining 48%. Yeah, so because these two US shareholders own at least 10%, so that is actually 10%. So, and again, the combined, share is greater than 50%. Yeah, so basically.
That makes Forco a CFC, right?
Yes, that's right.
And then I determine whether it creates sub F. Whoa. It's back. Okay. So first, is it a U.S. shareholder? Then once I identify the U.S. shareholders, I sum their ownership, and it's got to be greater than 50. Then I'm in the door to subpart F. It doesn't mean I have subpart F. It just means now I have a CFC that may create subpart F income. I have to then get granular and look inside what's going on in that organization and determine whether it's got the items of income that would be included that we'll talk about here shortly. Okay, thank you. 5-5, anybody, somebody have 5-5? Chin.
Non-memory element, non-resident alien, on the remaining 41%, because only U.S. shareholders that not own more than 55 of the vote or value for company. So for company is not a CFC, even though U.S. persons elected to own more than the one of the whole company, 59%, then they owned in the previous example, 52%. So because the U.S. shareholder just holds 50%, so it is not more than the 50%. So it is just the U.S. shareholder, but not the whole company is not CFC.
Correct. And so two things are going on here, right? George Washington gets kicked out, doesn't own 10%, so it doesn't count in the 50% test. And the 50% test, don't forget, is greater than 50. So if it's exactly 50, it doesn't count. So what does that mean? That means this is not a CFC. Meaning that it could have the types of income we're going to explore in a moment that would normally be subpart F, but we don't count it under subpart F because it's not only CFCs can generate subpart F income. That's included. Perfect. Thank you. Okay, last one I think 5-6.
100 unrelated U.S. citizens each own 1% of Forco, a foreign corporation. Although Forco is 100% owned by U.S. persons, none of the U.S. persons satisfy the 10% ownership test for U.S. shareholder status. Therefore, Forco is not a CFC.
Yep. So same as the prior example, it could create the types of income that we're going to talk about, but it's not currently included in any of those owners' income because it's not a CFC. Okay, so what are those income streams? George, go ahead.
So if one of the shareholders holds less than 10%, but their combined shares with.
So walk through your fact pattern again.
One of the U.S. shareholders has less than 10%.
Yep. So then I would be, right, because I have at least one owner that's greater than 10, a U.S. person. That makes them a U.S. shareholder. and do all of my US shareholders, which could be one person, one US person, if that's greater than 50, then I'm a CFC. So like this fact pattern in 5.6 is very rare, right? You don't have 100 shareholders of a foreign corp. That's pretty rare. Usually you have more concentrated ownership, so it's a little simpler. Like we'll see. Okay, so let's say we're in the front door because we've assessed who's a US person, who's a US shareholder, and do we have control, so it's a CFC. Now we gotta go inside the CFC and see what type of income, because subpart F only applies to certain types of income. Okay? And those are 3 buckets. It's gonna be, they're a little wordy here, especially the first one, but I think they're pretty simple to kind of think through as we walk through them. Foreign personal holding company income. This is your investment type income. This is where the US is thinking about that first exposure, where if we had pure deferral, the movement of ownership of assets can pull income streams with the asset. And those passive types of asset income streams, that is what you're gonna see is gonna fall in the first bucket here, what is called foreign personal holding company income. FPHCI. Okay. B and C are transactional flows. Looking for base companies, you'll see base company in the examples. That's that German Jerco and Keiko example. Do we have a base company in our transaction flows? Either sales, that was that example, we had sales of inventory, or I could do it with services. We'll have some examples on services. But that's where I'm doing it. I control a foreign subsidiary. Can I put some income in there by the way I structure my global transactions? And that's where the US can also try to pick up and currently subject those earnings into US tax.
I was gonna ask, like, for companies, how do they, I guess, disclose if they have like subpart F income, like in like a 10K or something? How would they exactly, are they required to?
So you wouldn't see it, I don't think you would see it directly in a 10K. It would be indirectly via their tax expense. So this, what you'd see is this becomes taxable income in the United States. Now, where they might have to explain it if why is their tax rate higher than what their facts look like? So you could imagine an analyst looking at the org chart, it's like, I see you got a bunch of Cayman Island companies, and I would assume there's income in there. Why is your tax rate higher than 21? Or why is it closer to 21 and not lower because you have some of these low tax countries in there? And then that's where the answer might be, well, it's that example where the income stream that was going from the US ultimately to Germany was routed through Keiko. But you'll see the end result is that Cayman profit would be taxed at 21% because the US is including it in their tax return. So your facts might look different than your tax expense. But it wouldn't be separately spiked out, I don't think, in a 10K. I don't think somebody would, unless it was just super material, that somebody had to spike it out like that. I think you just see it buried in US tax.
My question is about more tax planning. So subpart F, it kind of creates like phantom income. So how do companies plan their liquidity to pay off that tax?
Yeah, so what you'll see, remember the Cayman example? It had no connection to manufacturing, no involvement in sales. So it had bad facts, right? I was just buying and selling through a box on an org chart and trying to put some income in there. Well, what if you changed your facts? And maybe Keiko is not a good example because most people, when they go to an island, they're vacationing and they're relaxing and they're not working, right? So, but what if I took, in place of Keiko, I put Ireland? What if I have people in Ireland? And I have salespeople in Ireland that are managing the customer relationship. Then some of the income does belong there. And maybe it's not subpart F income when we get through these rules. So I have to do something more intrusive to the business. And this first part, what if instead of moving the asset from the United States to the foreign country, what if I start the asset in the foreign country? So knowing the rules and they're very objective rules, means you can set your facts to not be in the rule. So, lazy, simple tax planning is gonna get caught. But thoughtful tax planning, like working with your supply chain people and really putting centers of excellence and housing where your employees are, where your manufacturing is, has a better chance of surviving these rules. So that's the challenge. And I like that, because if you're a tax planner, if it was simple, then everybody could do it. Like, well, that's no fun. I want it to be hard so that very few people can do it. Okay, so let's start with the first bucket, foreign personal holding company income. 5 9s, you may have 5 9. Why not? So here I put in red, this is the way I want you to think of the wordy foreign personal holding company income. Think of dividends, interest, rents, royalties earned by the CFC. Okay.
So you are from company who own the
So British Virgin Islands, I believe, is still a 0% jurisdiction. It's equivalent to Cayman Islands from a tax perspective. Commonly thought of as a tax haven.
the only the employee is the British Virgin Islands company who incorporated the company from company. You as from company contributed the tax to people from company that the big company used to purchase the rights to drive from this is just for the cancer nurse. And people from company license the drug worldwide for royalties. So these royalties constitute the foreign personal holding company income. So I think the royalty is like the profit shifting.
Yes.
So yes, this is the passive and usually movable income earned by the CFC. The you as a shareholder must include it counted under the subpart F, even if no dividend is distributed.
Yes, and great summary. So the facts here are important, right? There's only one employee. That should immediately make you nervous. Like, what can one employee really do? Especially in a pharma space, and this person is an attorney, and this person is someone who incorporated the business. So they're not even like really a functioning employee in the pharma business. And so the way they move the income here is they put the cash in there to buy the asset. Right? They could have already owned the asset in the U.S. and contributed the asset down there, but functionally they got there by putting cash in there, buying the asset, and then collecting the income from the asset. That's fine from a business perspective, but the U.S. is going to say, well, there's no reason for me to defer that income from current U.S. taxation. So what I'll do, this is a CFC, forgot to do that, right? It's a CFC because I own 100% of it. I'm a U.S. corporation. So it's a CFC. I look at its income stream. Yes, it's got a big royalty income stream, and I am going to tax that in the United States, meaning that what you thought was taxed at 0 is now taxed at 21. Put on the U.S. tax return. This goes to Connor's question that if someone looked at this and was like, oh, I see you got a BVI pharma subsidiary, why is your tax rate 21? Well, that income that's there is taxed currently in the United States, so I don't get the advantage of the 0% rate in BVI. Okay, thank you. Okay, 510. So now this is going to pivot off of that prior example with better facts. Come on now. Facts matter. Area.
Yeah, as in the previous example, U.S. Farmco wholly owns BVI Farmco, the CFC incorporated in the British Virgin Islands. However, BVI Farmco employs 20 scientists in white lab coats to develop a drug to calm the nerves of overzealous urban occupiers.
So great facts, right? I got lab coats. I'm a pharma business. I'm expected to have lab people, right, developing stuff. So I got a Center of excellence, yeah, it's kind of weird, it's on an island, and somebody would say, oh, that, I don't see a lot of that, but it is what it is, if I actually have that, that's my facts, okay?
UBI Farmco licenses the drug worldwide for royalties, which are not a foreign personal holding company income, because UBI Farmco actively conducts the trade related to drugs.
So what this is trying to draw out is, yes, royalty income as a general matter is the type of income stream where we would look at a CFC and try to tax that currently. But we have an exception if you are in the active conduct of that trade or business and you receive from an unrelated person, and you receive those royalties from an unrelated person. So the active conduct here is the 20 scientists, right? That's the active nature of the business. They are licensing it, they're collecting the royalties, so this would not be, even though the income stream of royalties count as subpart F income for purpose of the CFC. Okay, this is where the factual that's math. Okay, okay, 511. This is drawing out on dividends. 511. Anyone? One eye.
So in this example, USA co-owns UK Hold, which is a holding company based in the UK. And the UK Holdco has 3 operating companies in the UK. And dividends paid by any of the 3 operating companies are not considered foreign personal holding company income because UK Hold is receiving them all from.
So this is not an uncommon fact pattern. When you look at a fully mature multinational corporation, I might have multiple subsidiaries in a single country because they might be doing multiple things. One might be a sales operation, one might be the manufacturing operation, one might be a service operation, and I just want to have them in separate corporations. And then I might go further and I might put one single same country holding company above it. Maybe that's where I put management for the UK. Maybe that's where I put management for all of Europe in that holding company, and they oversee all 3 of those operating subsidiaries. But however I structure that, this is an exception that is saying, although I look to dividends of a CFC in determining what is foreign personal holding company income, this is not the kind of dividends I'm looking for. This is just UK to UK by virtue of you have set up a common holding company in the same country operating subsidiaries in the country. Okay? So you can't just look at the words and is it royalties, dividends, you also have to go down a layer below that, see if there's exceptions to that. Perfect, thank you. Okay. So, foreign personal holding company income, there's a look-through rule that applies such that income nominally constituting a dividend, interest, rent, or royalty received by a CFC from another CFC is not considered foreign personal holding company to the recipient CFC to the extent allocable to active business income of the CFC. Remember, this is we had a similar look-through rule when we were doing putting the income in the different baskets. And so that's where we look through, so we don't just get stuck on the nominal form of the payment. We look through the payment to what was the activity that gave rise to the wherewithal to pay the payment. Like, where did the income come from? How did you make the income to be able to pay me that? So this is a similar rule, but it's for purposes of subpart F. But we're looking through the nominal forms of the payment. And it's only from one CFC to another. I have one big org chart, and I have one of my foreign subsidiaries that's a CFC paying another CFC a nominal flow of income. So what the US is saying in that common controlled pattern, what I want you to do is look through the dividends, interest, rents, and royalties to see what did that paying CFC do to get the cash to pay you. Okay? And so that's when we would, if it's an active business, it's not doing anything itself that would create subpart F income, that would then pull that passive income stream out of foreign personal holding. We just got to be careful in that fact pattern. And so, foreign personal holding company also includes gains from the disposition of property that produces dividends, interest, rents, and royalties. So like that BVI example where they owned an intangible that they, a license that they were, or a intangible that they were licensing out for royalties. If they sold that intangible, then that gain on that sale would also be subpart F income, just like the royalty income, which makes sense. It's just kind of the counterbalance of the current income stream with the future sale.
I'm wondering if the IRS investigate the CFC to determine whether they have a real operating activity.
So the IRS will, so if you claimed, so those two BVI examples, right? One had bad facts, one had good facts. The IRS would ask questions about that. So in that, in the reporting you would do on your tax return, you would have claimed that that royalty income stream in the second example was not subpart F income. And the IRS can ask questions on that. It's like, well, I see you got royalty income coming into that. Why is that not subpart F income? That's where you'd say, well, I got 20 scientists employed there. They might say, well, what do? Well, they create this IP and they manage the IP and they keep tweaking it and everything. So it's very active to the business. So yeah, the IRS could ask questions on that. So, and that's when we get into some of the subsequent categories, there's some very good litigation history because these are big dollars for companies that have done this planning, and the IRS takes people to court, and then they have these big, long, drawn-out court cases. Really good question. Okay, so the second category I want to leave you with real quick is foreign-based company sales income. So this is the example that we went through with the Keiko in Germany, right? Base company, and then I'm doing sales, so I'm routing things to it. So you're looking for the third wheel, something that's not involved in the transactions. So foreign-based company services income includes income, whether in the form of sales, commission, fees, or other income. So it's not exactly how you structure it. If I would have done that sale from the US to Jerko directly and I paid a commission to Cayman Islands because I thought I was smart and I didn't sell it, but I paid it, the US says that's the same effect. So if it's in connection with the sale, so don't be caught up in how a base company is compensated. Derived from the sale of personal property that is manufactured outside the CFC's country of incorporation and is sold for use outside the CFC's country of incorporation and involves a related person on either the purchase or the sales side. The way I like to think about this, the way you identify this as a shorthand, because that can be kind of wordy, is look for personal property that crosses two borders and one of the parties on that is a related party. You will always smoke out foreign-based company sales income in that scenario. We're crossing two borders and a related party on one side of that. The foreign-based company connotes a CFC that is not located in the country of manufacture or sale, which may be organized in a low-tax country, primarily to lower global tax. So let's go back to the Keiko example. Okay. If I am selling case two, I sold from the US to Cayman, Cayman sold to Germany, who sold to customer. Do I have a foreign-based company sales income? Go with the shorthand. Did it cross two borders? Did the property cross two borders? Yes, it went from the US to Cayman, and it went from Cayman to Germany. Two borders. Was there a related party at least on one side of that transaction? Yes, Jerko is a related party to Cayman because they're owned by the same owner. That would immediately smoke this out as being potential foreign-based company sales income. Then I would have to go in and say, do I qualify for an exception, i.e., does Keiko do something relative to this product? Either additional sales activity, do they assemble it, do they do some additional manufacturing, something. Because they can't just buy it and sell it. They have to do something, and is that enough that the IRS would say, I'm not going to tax the income? Okay? All right, we will pick this back up on Monday, and I hope to get all the way through Chapter 5, and I'll send you a note tomorrow as to where we head. Okay? Thank you.